Hello, everyone. My name is Natasha Johnson, your North Carolina life insurance agent. I hope you guys are doing well today. Um, Today, I'm going to illustrate the Total Secure Whole Life product. I'm going to illustrate on a 20-year-old, a 30-year-old, and a 40-year-old. We're going to talk about for those three just pure insurance. And then for the 41-year-old, the investor, we're going to talk about the cash value side of it. So the first three, they're not looking at the cash value. They just want a death benefit to protect their family. So the 20-year-old, I am going to start out with $100,000 death benefit. Let me go in here and put his age in. Okay, so he wants $100,000, and I'm going to show you what it looks like without the term policy, and then I'm going to show you what it looks like with the term policy. Granted, whole life policies are more expensive than term policies, so I want you to keep that in mind. Also, age plays a big factor in this, okay? So the older you are, the more expensive it is. So this is a 20-year-old, and he's wanting a whole life total secure policy. He's not really worried about the cash value. $100,000 face amount. He wants to pay monthly for this, and this is the contract premium. Divide by 12, you will get your number. And so to see what this looks like, it's $65.38 for this person. As you can see, this is the contractual premiums, the annualized premium, which equals up when you divide it by 12, it gives you this. This also grows annual dividends, and here's the cash value, which he's not worried about. But this price to him is because is too a little too much for him because he is on a budget. So we want something a little bit more budget friendly. Now this is where the term rider comes in at. Okay, so keep this in mind. If you want a whole life policy, we can make it work for you. Okay, so we're going to go back to death benefit, and we're going to change this face amount to $50,000. And then we're going to go to the rider, and we're going to say that he wants a term rider, and it already defaults to $50,000, and it already defaults to 20-year term. Okay, so with this, he wants a 20-year term. Meaning that this $50,000 lasts for 20 years. Once that 20 years expired, then he's back to the base $50,000. So let's go back to quick view. Now his payments is $39.12. So what that means is that he has a 20-year term rider added onto this policy. So in the event that he dies before that 20-year term, his beneficiary will be paid out $100,000. But if he outlives that 20-year term, that $50,000 20-year term, and dies after the fact, then his beneficiary will only get $50,000, if that makes sense. So let's bump it up to a 30-year term, which won't be but a couple dollars more. I would recommend that this person will go with the 30-year term, and it's only $41.50. So this is a way to get a whole life policy for a little nothing. But granted, if you are a 50-year-old or older, it's still going to be expensive because the older you are, the more expensive it is. Okay, so now we're going to go back to client information. We're going to illustrate on a 30-year-old who actually wants the same thing. Make sure my rider is cleared out. Okay, death benefit and funding. He wants a $100,000 face amount. He wants me to see what it looks like for him. So this one is $1,062. And so let's make sure everything is good. Go over here to quick view. His payments is $88.53. So he also wants to be on a budget, and again, not worried about the cash value. So he wants to see what it looks like with a term rider. So I'm going to do him the way I did the 20-year-old. So we're going to go back to death benefit and funding. We're going to change the face amount to $50,000. And then we're going to go over here to the rider and we're going to add a term rider. Again, default 50,000, default at 20-year term. And we're going to go over here. As you can see, the contract premium is $612. We're going to quick view, and now $51 for this patient, for this client, not patient, but client. Again, not worried about the cash value. As you can see, it grows annually dividends. And so pretty much the 20-year-old and the 30-year-old is basically worried about the death benefit only for their family. So again, let me explain to you, if this person was to die within that 20-year term, that $50,000 that was added, if they were to die within that term frame, then his beneficiary will be paid $100,000. But if he outlives that 20-year term and then die after the fact, then his beneficiary will only be paid $50,000, if that makes sense. So I would advise him to go up to a 30-year term, which wouldn't be that much of a difference. $53, what, $2? All right, so I'm going to illustrate on a 40-year-old. Now, this 40-year-old wants $150,000 death benefit, okay? He wants me to see what it looks like without the term rider. So I took that out, and we're going to go back to death benefit and funding, and we're going to change this to 150,000, I'm sorry. All right, so as you can see, 40 years old, $2,346 annual premium, divide by 12. Without the rider, it will give you $195 a month. $200 a month for $150,000. That's a lot. We're dealing with a whole life policy that's very expensive. Okay, so now he wants to see what it looks like with the rider added to it. So I'm gonna flip it around. So I am going to go back to my death benefit and funding, and I'm going to change my base to 50,000. And then I'm going to go into my rider and I'm going to add 100,000. Okay, and I'm gonna leave it at a 20-year, and let's see what it looks like. Okay, so now we're going to quick view. So this person would pay $82.28. If we go up to a 30-year term, then it will be $96, I believe. But he wants to stay right here because this is more feasible for him. Okay, but he doesn't like this cash value. So he wanted me to figure out a way or show a way to where his cash value can grow. So what we did was, over here, we'll go to a 41-year-old. Let's change the age to a 41-year-old, because then it's going to change this to 7,000 and some change. So let's go back to death benefit and funding, and we're going to, not death benefit and funding, but client information. I'm going to change this to 41. And see the contract premium, $1,035. So that's the same. We're going to go to quick view. So it is $86.33. So he wants to put in $6,000 a year. So he cannot go over this number. If he goes over this 7,000, then he is subject to taxation. The policy could make. Okay, so when we do this $6,000 for my investor, I explained to him that the policy will be paid up at age 60, because it's going to pay the policy off quickly, because you're overfunding the policy. That's what that is. But this is what he wanted to do, because he wanted to see a difference in the cash value. So we're going to go to death benefit and funding. We're going to change his modem premium to annually. We're going to change this contract premium to specify, because we're going to specify the amount, and we're going to put in $6,000. Okay, everything looks good on this side. We're going to go to quick view, and now he's putting in $6,000 a year. For the first 3 years, he was able to pay $6,000. Now, remind you, This has been overfunded. So then after the first 3 years, then you start seeing the annual premiums decrease to 34 a year, 176 a year, 176 until we get to age 60. At age 61, this policy is paid up. He can no longer fund it anymore, but the cash value is what he wants. So if you are looking for cash value growth, then cash value growth, then this is the way that you will want to go, or an IUL. If you're just looking for a death benefit only to protect your family, then the other 3 ways that I showed you, and you want a cheaper cost, that is the way to go. So I want to thank you guys for tuning in. I hope this video was beneficial and very informative. If you want to book a consultation, please just use my calendar link at the bottom. You can call me at 828-794-8111 for more information. Again, thank you guys for tuning in. And my name is Natasha Johnson, your North Carolina life insurance agent. Thank you for tuning in. Bye for now.